So when valuing a company, you actually have to be clear about value of what. You can think about equity value, and that represents the value of the business to the owners. So if we think about that lemonade stand that we just went through in our accounting section, equity value is the amount that you would get that would go into your pocket if you sold your lemonade stand, right? So you are the owner of the lemonade stand. You sell it, you have to pay off all your debt obligations, and then whatever you put in your pocket is the value of the equity. All right, that's different from another concept of value called enterprise value. So in addition to equity value, finance professionals very frequently want to actually look at not just the value of what goes into the pockets of shareholders, but what is the value of the entire enterprise? In other words, what is the value of all of the operations of the business, not the equity? And a really simple example will help illustrate the difference. Imagine you own a house worth $1 million, but you have an $800,000 mortgage. Well, if you sold the house today, you'd have to pay off the bank after you got the $1 million. The bank has a note on it for $800,000, so what goes into your pocket is $200,000. That's your equity value. But the enterprise value, the value of the core business is $1 million, right? So a way to think about this is that the enterprise value doesn't care how the business is capitalized. And capitalized means whether the business was funded with debt or equity, right? Enterprise value is sort of what we call an unlevered measure of value. It means it doesn't really care about any of the capital structure or the leverage that exists in the business. It's just purely what is the value of the operations. Whereas equity value is very much a levered measure of value. In other words, it is a measure of the value just to shareholders, kind of a residual value after everyone that's not an equity capital provider has been accounted for. So using the house as an analogy, it should be easy to see how enterprise value is very much interlinked to equity value. In fact, enterprise value informs the equity value, right? Imagine if the house value that we just talked about jumps from $1 million to $1.5 million. Well, all of a sudden your equity value, by definition, has jumped from $200,000 to $700,000. It is the residual value after these fixed contractual debt obligations are paid off. So now that we've defined kind of broadly the of enterprise value and equity value, let's just be a little bit more specific about what equity value and enterprise value represent. And in a second, we're going to connect it to our lemonade stand balance sheet. So enterprise value is the value of the company's operating assets less its operating liabilities. It's the value of the company's operations. And for the purposes of defining enterprise value this way, most financial analysts basically say, well, cash, even though you can make an argument that you need cash for your day-to-day operations, really anything like cash, other investments, it's not really tied to your operations. Those are more financial type of assets, right? So operating assets, really all assets except for cash and other investment assets, and operating liabilities, really anything related to your operations, like accounts payable and accrued expenses, any liability except for really debt and financial